What is forcing Japanese life insurers to invest in foreign bonds? Exceptionally low interest rates. To make a very simplistic discussion of the insurance business, insurance providers make money by doing the following. 1. Estimate to the best of their ability, with their armies of actuaries, how much they expect to lose to insurance claims per year. This can be thought of as an estimated loss yield, e.g. I expect to lose 2% of what I collect to pay out life insurance claims based on my actuarial models that predict how many deaths will occur this year. 2. Given the expected loss yield, invest the proceeds from premiums collected into relatively safe, yielding securities that will earn the provider a higher return than what I expect to pay out in claims. I can dial my risk up or down to increase or decrease my expected return. 3. Collect the spread and pocket, reinvest the remaining premiums after all claims have been paid off. Rinse and repeat. Traditionally, insurance companies tend to be more conservative when it comes to their investments, for good reason. There is no more valuable asset to an insurance provider as trust and solvency. As a result, insurance providers have historically been heavily invested in domestic government bonds, arguably the safest of all assets. However, the issue in Japan is that government bonds are yielding essentially nothing, and even negative in real terms if you factor in inflation, as a result of the massive quantitative easing programs implemented by the Bank of Japan. Thus, insurance providers are faced with the pain of earning less on their portfolio of premiums than they are paying out to claims. In addition, Japanese insurers in particular are also faced with the headwind of an aging population and demographic dynamics that make the environment particularly difficult to navigate, as the proportion of the population entering the final and high-risk phase of their life is much higher than other nations. This dynamic effectively translates into higher expected claims per year, which forces insurance providers to raise premiums or find greater returns in its investment portfolio. Given the exceptional savings behavior of Japanese citizens, my guess is the price elasticity on life insurance is too high to allow insurance providers to raise premiums to the degree they need to without adversely impacting their bottom line, forcing them to shoulder some of the burden through seeking higher returns in their investment portfolio. Given the paltry and even negative returns on these securities, many insurance providers have been forced to seek better returns elsewhere, while maintaining a similar conservative risk profile. This makes foreign government bonds a natural place to look, particularly in other safe haven reserve currency nations like the US with credibility and near certainty of solvency. Maintain a similar risk profile, earn a better return. A classic carry trade. This is by no means a complete or thorough answer, but hopefully this helps answer the basic dynamics of why Japanese insurers are looking to invest abroad.